Hi, I'm Bill Rayman, mortgage broker in Los Angeles. I have interesting news today of something that's made a reappearance. In the mortgage industry, years ago, there used to be something known as stated income. It developed a very harsh reputation. In fact, it was dubbed liar's loans because it allowed an individual to simply tell a bank how much money they make per month or per year, and that was used to determine whether they qualify for a loan. The reason it was called liar's loans is you had situations where, back in the go-go years, banks weren't verifying anything. So there were all sorts of probably true, but let's say apocryphal stories of the migrant worker who went and got a $350,000 loan, the nurse who was able to qualify for $250,000. And I don't mean to imply that that particular nurse, if she is real, wasn't earning enough money, or maybe she had other sources of money that she could qualify for it. But nonetheless, the banks were doing a terrible job of trying to validate that what someone said was true. Now, stated income works if you don't have to show your tax returns or a year's worth of bank statements so they can audit basically your account. With the downturn in the market, stated income was one of the things that was almost immediately dashed. Banks didn't want to have to deal with that anymore. Obviously, banks want to deal with qualified borrowers who are going to pay back the loan, because ultimately that's really all the bank cares about. If they lend you money, they want to know that you're going to pay it back on a regular basis. Having equity in the house, having a lot of equity in the house, that's just a given for the bank. Having great credit, that shows responsibility, that shows you're going to pay the bank back. But ultimately, you have to have the financial wherewithal, which is to say your income. Now, in 2014, really because of the strength of the company I work for, Guaranteed Rate, we were able to pull together a true stated income program. It's designed for self-employed borrowers. Generally, self-employed borrowers have more complicated tax returns, which, going back several years, I believe was the initiation, or why stated loans came along, was the banks had trouble dealing with complicated tax returns. They like wage earners. So the stated income program we offer now is for self-employed borrowers. It's a valid program in that no tax returns are needed. We don't ask for what's known as the IRS Form 4506-T, which virtually every loan you go anywhere to do, you will need to sign. That form allows the bank to contact the IRS and get a transcript of your tax return. They will match that up against the tax returns you give the bank to make sure what you're giving the bank is in fact what you filed with the IRS. So if we're not using tax returns or pay stubs or the 4506 to generate, authenticate your income, it really is a stated program. What we do is look for other ways to validate that what you tell us you make is true. So for example, we'll go on to websites like salary.com and see that if you're a general manager of a department store, your income range around the different parts of the country is going to be within a range. If you were a chiropractor working in a particular county in a particular state, their websites will show what chiropractors in that environment generally make. So there'd be a test of reasonableness to see if that's there. Then for basically every loan, we look for a couple of months of asset statements. That's typical for most loans. In this case, we want to see that there are deposits going in and out that sort of reflect that your business is viable. Then you have to demonstrate you've been doing this business for at least 2 years. You can do that either with a business license. So if you're an attorney, a doctor, many professions you require licensing, you'll produce that license. More typically, if your tax returns are done by a professional, typically a CPA, but it could be an EA or it could be a professional who's neither of those things, we're going to require that person to write a letter saying that they've done your taxes for these years, that during that time you've been self-employed in the same line of work, etc. So for a self-employed borrower, it's not atypical for you to want to and be able to minimize your income to minimize your taxes, and do that also by maybe magnifying your expenses or writing things off in a previous year. It's all valid financial stratagems, but if the result is you're showing less income on your taxes, then your tax returns won't qualify you for the loan you need, you might want to turn to stated income. The program that we have is unique in that the debt-to-income ratio is in the same line as other banks. The credit score required is 700, which is well below the national average. The national average for credit scores is now 737. So reasonable debt to income, reasonable credit. You need to have liquid assets, both in the bank and in reserves. The interest rates will be a little bit higher than you would get if you could do full doc, but that difference is, I think, financially mild, and certainly well worth if you're able to buy the house with a stated income loan and not buy the house without it. I think you can see there might be an advantage of paying that slight premium. There's no points charged for it. We do this directly through our in-house channel, and it's nice to welcome back to the fold stated income.